This is Brent with Black Lion Capital Management and the U.S. Petroleum Report for Wednesday, March 2nd, 2016, featuring Update Analytics, incorporating data from the Update Energy Feed, Energy Information Administration, Baker Hughes, and CME Group Nymex. Highlights from this week's report: production continues to decline while we're at a century-low total rig count. Commercial crude oil added over 10 million barrels to storage, setting a new record. Cushing, Oklahoma, total petroleum storage both set new records, and prices are up against resistance with positive price targets. Let's go to the charts. Starting with U.S. continental production for the lower 48 United States, another decline this week as we zoom in here, down to less than around 8.6 million barrels per day. You can see the previous low we set in 2015. We've now descended below that, and the 52-week moving average, the heavy blue line, has flattened out, and we're continue trending well below that. U.S. field production, this includes the lower 48 plus Alaska, down to 9.1 million barrels this week, taking out the low we previously set in 2015. So some of this reduced exploration production activity is beginning to be reflected, albeit with a huge lag and very slowly, in the production. Commercial crude oil storage, this excludes the Strategic Petroleum Reserve. Mentioned this at the top of the report. You can see in the bottom pane here where we include each week's increase or decrease, the more than 10 million barrel increase in storage. You can also see in the top pane the 2015 record of 491 million barrels, and this week we're at 518 million barrels and continuing to trend higher. The seasonal comparison charts we do for crude oil and the two petroleum products we track are all constructed basically the same. In the top pane, we have 12 to 14 months of commercial crude oil storage. The silver dash line is the 10-year average of commercial crude oil storage at each of the given weeks. We take the delta between those two and plot it as a bar graph. That's the green bars in the bottom pane to determine whether we have a surplus or a deficit. In this case, you can see we have a 196 million barrel surplus, an all-time record for the last 14 months. Cushing, Oklahoma is the physical delivery point for Nymex light sweet crude oil futures. It sets a new record this week at 66 million barrels after adding nearly 1.2 million barrels to storage. Total petroleum storage tracks commercial crude oil plus the 12 refined products maintained by the Energy Information Administration. Another new record for this data point, following a near 10 million barrel increase in storage here, consistent with that increase in commercial crude oil storage. Exploration production activity is measured by the Baker Hughes rig count. This particular rig count comes to you from Baker Hughes as the rotary rigs focused on exploring for oil solely in the United States. After last Friday's report, we're down to 400 rotary rigs exploring for oil. I've drawn the brown dash line horizontally there to go back and see that this is the lowest level we've experienced since December of 2009. Also mentioned at the top of the hour, the total rig count. This also coming to you from Baker Hughes. This is the total number of rotary rigs in the U.S. and Canada, so all of North America. And these are rigs that are focused on exploring both for oil and natural gas. Down to 473 after stacking out an additional 14 rigs. I've used the same methodology here and drawn the brown dash line back, and it intersects all the way back in July of 1999. So each time this sets a new low, this is a new low for the 21st century. Something else to add to our scan here is the red dash line. That goes all the way back to the early part of 1999, and that's the all-time record low for this statistic, and it wouldn't be surprising to see us descend down to that level of exploration and production activity. So how's all this weighing on pricing? Well, we begin by taking a look at the seasonality chart. The top pane is Nymex light sweet crude oil futures. This is the continuous contract from the Update Energy Feed. And then the bottom pane, the 10-year weighted average of annual seasonality. This gives us an idea of where demand or excess or lack of demand will come in during different times of the year. Beginning in the early part of February is when we began to see seasonal strength for 2016, and you can see, consistent with the bar graph in the top pane, that's what's occurred. As we've gone through February and now into early March, we've had seasonal strength, and we have had somewhat of an uptrend in crude oil. This should last until roughly the end of April or May, albeit there could be some volatility in there. This is the daily cloud chart that we look at each week, things that we look for to help us determine the trend in crude oil here. First one is the price line represented by the red and white candlestick chart, and then the blue lagging line. Both of those are below part of the cloud span. Now the price has increased and we are now within the cloud span, but to have a confirmed uptrend we need that blue lagging line to penetrate up through the clouds. The cloud spans are still negative. That's what the pink shadowing indicates. And then we do now have the green turning line is above the purple standard line and the price above both of those. So there are some signs of bullishness beginning to show up in this daily chart. However, we are a good distance away from seeing a new uptrend begin. On update analytics, if you go Shift T, this will very quickly draw a three-box reversal, or however you decide to construct it. I've got it set up to draw a 1% logarithmic point and figure chart with a three-box reversal, similar to what we see on that cloud chart. We're below bearish resistance. We're below several intermediate downtrend lines. We do have one upside target. It is active up to $41, so about a 20% increase, and that is something that would take us above those cloud spans and give us a new positive trend on the cloud charts. Although for that to concur on the this point in figure chart, we would still have a way to go, but you can see that would take out several of these intermediate trend lines and at least give us a new intermediate uptrend. Two downside targets that are active here, one to $13 and one to $15.45. The 60-minute point and figure chart, this data is coming to you via eSignal. This is their continuous contract, so this is not roll adjusted, and we'll see later on with gasoline some of the implications of that. But I've drawn this heavy blue dash line where you can see we've run into resistance at $34.30, and that is holding strong today. You can see that we've rallied just above it on several times, have been turned back. But the other thing to take away from this chart, there are no active downside targets at this time frame. So right now we've got upside targets to $35, $36 3/4, $37, up to nearly $40. So 4 positive upside targets, no active downside targets. We are trading above bullish support. That's the green 45-degree trend line moving up there. But there is tremendous amount of resistance here around this 34.5 level. Every time we've run into this, we've been turned back. And today has certainly been one of the more volatile days with the report of the record storage and then the decreased production. Over to the 15-minute close chart, this is the actual futures. So this is CLJ6. We are over to the April contract for the front month. It doesn't look as terribly bad on this chart, but we were trading right here around $34. We got all the way up to $34.90, down as low as $33.75. All of this within a short span of time, as we keep running into this resistance up here at this $34.50, $35 level. We always take a look at the dollar correlation, since crude oil is an internationally fungible dollar-denominated commodity. And the top pane is Nymex light sweet crude oil futures, coming to you from eSignal. The heavy green line is the dollar index from ICE. Then we take the all-time correlation between the two, and intuitively we see that it is a negative or inverse correlation of -80. One of the things we have been tracking, David's been mentioning this on his Monday report, highly encourage you to subscribe to that, is that in the short run here in the first part of 2016, the short-term correlation, meaning the last 65 days or last approximately 3 months of trading days, that this relationship in the short term has turned positive, that the crude oil is demonstrating a positive relationship to the dollar index. We can see that a little clearer if we zoom in here and take a look at just this year. If we look at the dollar index here in the early part of February and crude oil, you can see that crude oil's trended steadily up as the dollar index has, and that's what's helped contribute to this positive correlation between the two. The Nymex forward curve data comes to us via the updated energy feed, still trading in its contango. If we go back 5 days ago, that's the now the heavy red dash line. With that slight uptrend that we've seen, although we keep running into resistance, you can see that the curve has moved up at all delivery points, but it has seemed to move up a little bit more substantially in the out years. So hopefully what that indicates is that the reduced exploration and production activity is beginning to be reflected in some of the out-year prices with possible lower levels of supply. Ultra-low sulfur diesel fuel had a 3.5 million barrel build this week. Again, we're about to start bumping up against that all-time record that we set previously, about 140 million barrels. We're not there yet, but we want to keep an eye on that. The seasonal comparison chart for ULS diesel, similar construction is what we did with commercial crude oil. The difference here is the blue dashed line is the 5-year average. Looking at the delta between those two, we've got just over a 38 million barrel surplus of ULS diesel. Seasonality for diesel looks very similar to what we saw for commercial crude oil, although this short-term spike from the end of January up to the end of February and early March, you can see that that's now over, and that we're in a time here where we're just going to be moving sideways. So the time of real seasonal strength for diesel fuel is now past. The daily cloud chart, this is we look at the same things here that we looked at commercial crude or light sweet crude oil. We notice here also prices have climbed up into the cloud. Some things to look at on diesel fuel that gives us just a little bit more bullish sentiment. The cloud spans have begun to reverse there at the right side. The turning line is above the standard line. Price is above the turning line. However, we really need to get up well above this $1.15 level and have the lagging line through that cloud span before we would consider this into a new positive trend. Sitting here right now knowing that we're coming to the end of seasonal strength and bumping up against another all-time record for diesel storage, it's hard to imagine that could happen, but we definitely want to monitor this chart every day. Shift T, and this draws that 1% logarithmic 3-box reversal point and figure chart. Just like we saw before, we are still working below bearish resistance, but we have in the short run seen some positive action. 2 upside targets to $1.25 and $1.28, no active downside targets. The 60-minute chart for diesel also bears out some of the same concerns that we had about crude oil. We are trading above bullish support. The green 45-degree trend line, we did violate bearish resistance. However, here we have about $1.11 where we keep coming into this resistance, and I'll try to make that a little more pronounced. Very easy to change the formatting of trend lines and whatnot and update the analytics to suit your style or who you'd like to share these with. But you can see that heavy blue dash line there at $1.11 that we've come up and touched it 4 or 5 times now. And beginning to, it looks like we might be making some headway. Nothing but positive price, or 3 positive targets, 1 negative target. We do have this one left over here in early 2015. The 15-minute chart, this is HOJ6 from Nymex, so this is ULS diesel for April delivery. You can see here, just because of the slope of the curve, the resistance will be slightly above where the continuous contract is, and sure enough, it's $1.12, and that's the same blue dash line. But you can see that each time that we've come up and touched this or got in the vicinity, we have been repelled, but we are making a series of higher lows into this resistance. It's just going to be a matter of, will the fundamentals weigh out with the record storage and the record surpluses and push this price lower, or will the volatility and seasonality continue and possibly push us higher? But it is just important to know where that resistance level is. The 1-to-1 crack spread, this is a function that's built in Update Analytics. It's very simple, very rudimentary, where we just take a look at the value of Nymex light sweet crude oil futures relative to ultra-low sulfur diesel fuel futures, and this gives us a rough gross profit on what we would realize from the refined product versus the crude input. Trading at $11.95, $12. We did get down here into 8, and then a couple of weeks ago as high as 16, and that's backtracked now. But still, if you go back and look, all through 2014, our lowest point was $15.50, and we really didn't fall off on this until the end of 2015. So still a very compressed crack spread for ULS diesel. Over to the forward curve. Go back and take a look 5 days ago. Very similar to what we saw with light sweet crude oil futures. We're higher at almost all deliveries. Gasoline this week, we've now had 2 weeks in a row of drawing down gasoline storage after setting that all-time record. However, we are still well above the high that we set in 2015. Over to the seasonal comparison. Same construction. In the top pane, we've got 12 to 14 months of storage. The light blue dash line, we go back now to a 10-year average because this is a more mature product, obviously. Take the delta between those two, and we get a surplus in the lower pane of 27 million barrels. We have backed off some from the record, but not surprising with those 2 weeks of drawdown. You can see the heavy red dash line takes us all the way back to the 2015 record of 243 million barrels. So we are still very well stocked with gasoline, even though we've had 2 weeks of a drawdown. The seasonality chart will look very consistent with what we saw from light sweet crude oil futures and ULS diesel. We start at seasonal strength down here in the late January, trend all the way up to the end of February, and now we're into this sideways transition. One thing, and we're going to take a much closer look at this very large gap in the chart, that has to do with rolling from one contract to the next month. That's why that is. Gasoline didn't suddenly skyrocket in price. We'll take a little bit closer look at that shortly. And this is the daily cloud chart. Some of the things we look for here, the same things we look for here as that we looked for on the previous charts. We still do have, we've got the price is actually above the cloud spans here, thanks to that gap, and that is solely due to rolling the contracts and the fact that this is a continuous contract from eSignal, so it does not adjust for those, whereas you have the option in Update Analytics with the Update Energy feed to pull up a contract that has been adjusted for that, and I encourage you to do so. In this case, we've got price above the cloud spans. We've got the lagging line is within the cloud span, turning line is above the standard line, obviously price is well above there. We're not ready to call this a trend change yet. Because of that huge gap move up, we would need to see prices probably up around $1.35 or so to get that blue lagging line up above there before we would consider this to be a positive trend. One thing we can do, though, is we know that there's a seasonal trend in gasoline. We just talked about it. Come back here and take a look at what happened last year, end of February, early March. Well, we see the exact same thing, where we had this big gap at the end of February into the start of March that took us above the clouds. We descended some, and then finally the lagging line came above the cloud spans. And you can see from that point on, we had this gradual trend upward until the middle of summer. That doesn't guarantee it's going to happen again, but we are setting ourselves up for a similar situation in gasoline. The big difference this year is we do have that all-time, or we're just slightly below that all-time record storage. The 60-minute point and figure for chart for gasoline, I do not have my point and figure chart set up to show the gaps. If I did, there would be a very large gap here with this spike up. However, even before we had the spike up from the roll adjustment, we were trading above, or we had broken bearish resistance. We were trading above bullish support. These two price targets here have been realized. One thing I like to do is just change the color of those so that I can glance at the chart. And then right now we don't have any other upside targets. Got to go all the way back over here to August and September of 15 to find a downside target. So with that big gap up, we do have a temporary trend change on the point and figure chart, but just realize that that came from rolling the contracts, and we'll take a better look at that shortly. Over to the 15-minute close chart. This is RBJ6. This is April gasoline futures, and you will note here that we do not see that huge gap. That's because this was the contract that was rolled over after the March contract stopped trading. So this is we still see this. There's some resistance overhead here in this contract at about $1.35. We haven't really gone up and pressed that recently. The 1-to-1 crack spread, not surprisingly, with that huge jump from March into April, that this has expanded quite a bit. Normally we're here between $30 and $7.50, and we are beginning to trend up here in 2016. Perhaps this could continue like what we saw in 2015, but this was very beaten down in our last report. And finally, the forward curve for gasoline. I want to go back here 5 days ago, and if we take a look and kind of isolate over here at the left side of the chart, each year at the beginning of the year, you can see that from the March to the April contract, there's a huge gap. You can see it there in 2017. You see it here in 2018. Similar case out in 2019. So this is where the March contract stopped trading. Here's where the April contract is trading today. So by virtue of this very sharp increase on the curve here, and what this relates to is refinery transitions preparing for the summer driving season here in the United States. This is the source of that large gap that we saw on the chart, and we can go back over there and take a look at that. Here's where that gap exists. That just comes straight off of the Nymex curve. This hasn't gone over to a positive trend yet, but if we do go back here, give me a chance here to zoom in. You can see exactly this time last year when we went from the end of February to the start of March. You can see this very large gap. It did take a while for the lagging line to come up above there on gasoline. So just be aware of how these markets are structured. We do have different opportunities with update analytics and the update energy feed to explore roll-adjusted contracts as well. You also have the ability with eSignal to customize a roll-configured contract, something I've not ventured into. This is Brent with Black Lion Capital Management and the U.S. Petroleum Report for Wednesday, March 2nd, 2016. Thank you for joining me. If you have questions, please email me directly. If you have questions about update analytics or the update energy feed, please reach out to them. Thank you, and we'll be back tomorrow with the Natural Gas Report.